Government Affairs Director, Government Affairs Director with the Realtors Association of South Central Wisconsin. Before we dive in, a quick thank you to our sponsors who make this possible. The American Association of Retired Persons, the Madison Area Builders Association, Accessible Housing Wisconsin, and the Realtors Association of South Central Wisconsin. We couldn't do Housing Week without them. Today's session is a look at the Dane County housing market, and we have four great speakers lined up. For anybody during the webinar that has questions, please put those questions in the Q&A box and we'll try to get those answered. First, we'll have Dave Stark, CEO of Stark Company Realtors, one of the oldest and largest brokerages in Dane County, founded back in 1908. He'll walk us through the residential market. I'll follow Dave with a short look at the Dane County rental market. Then Chad Lawler, Executive Director of the Madison Area Builders Association, will cover new home construction. Chad has led MABA since 2018 and also serves as a director at large on the National Association of Home Builders Executive Officers Council. And finally, Olivia Parry, Senior Planner with Dane County Planning and Development and the Director of the Regional Housing Strategy, will tell us about what cities and villages are doing to close the housing gap and what more we can do. All right, to get things started, we'll turn it over to David Stark.
All right, thank you, Robert. Let me share my screen here. Hopefully, is that done it? Oh, wait, I have to hit share just a minute. There we go. Can you see it? Okay, you can hear me. All right. I've got a number of slides to run through here, and I'll go through them as quickly as I can. My goal here today is to kind of give you an idea of what the Dane County housing market looks like as we sit right now and why it's that way. All the data that I have, most of the data has been pulled from the multiple listing service here. It refers just to Dane County, and it's single family and condo only. So just bear that in mind as we go through. And the first slide we have here shows the number of sales that we have in Dane County going all the way back to 1991. And there's a couple of things that you'll notice here. This big run up here was the housing bubble, followed by the housing crash, 7, 8, 9, and 10. Then we had our recovery. This little peak right here was the pandemic. And then, of course, when the Federal Reserve tightened monetary policy, we saw sales fall down to this level where they've been for the last 3 years through 2025. Overall, our sales have been growing about 1.6% per year if you just look at it over the trend line. So far this year, I can't say that we're seeing tons of improvement. Just through January through April, we had 1,719 closings last year. We have 1,746 so far this year. So we're heading for a very similar year, it would appear. You can't understand the Dane County housing market without understanding what's going on with mortgage rates. It's true all around the country. And I'm going to linger on this slide just a bit because there's a lot here and it'll kind of give a backdrop for a lot of what it is that we're going to be talking about. You will notice that over the entire period, this goes back to 2000 and runs all the way through 2020. In fact, it runs right through the end of this last month. So 30-year mortgage rate has been set up by Freddie Mac. And over that entire period, the average rate on the 30-year mortgage has been about 5.2%. Since January of 2023, when the Fed tightened policy, it's been about 6 2/3%. But you'll notice right here in the middle, I've got this red line that says quantitative easing. Back in 2007 or 8 or 9, probably 9, I think, the Federal Reserve started a policy of quantitative easing, which was basically buying mortgage-backed securities and treasury bonds and expanding its balance sheet. It continued this policy even after the economy recovered all the way through 2022. And in fact, during the pandemic in 2020 and 2021, it doubled down on that policy and went even further with it. The result, if you look at this chart, is that the only time that we saw mortgage rates below the average of 5.2% was during the period of quantitative easing. And the reason that's important is because a lot of people, I think, have it in their minds that someday we're going to go back to the times of 3 and 4% 30-year rates. My thesis is that shouldn't ever happen and probably never will happen unless the Federal Reserve starts doing its quantitative easing again. I don't think they're going to do it. So, and I don't think they should do it. In fact, Kevin Warsh, the incoming chair of the Federal Reserve, has been critical of the Fed for continuing this policy as long as they did. So I think you can likely assume it will not be coming back, which means that you will not be seeing interest rates much below where they are right now in the upper fives to low sixes, probably ever. And my feeling is that's a good thing, but let's see what the effect has been. So if you go back and look at this chart that we just looked at, here was the period that was covered by quantitative easing. Here was the recession that it dug us out of. But then for all of this period, even through the recession, when they juiced it a little bit more, you see where our sales level were. Once they stopped it, our sales level dropped down here. And what it makes me wonder is where our sales levels are going to return to, given that our mortgage rates are not going to be returning to the 3 and 4% level. I think from an affordability standpoint and from a transaction standpoint, I think it's going to improve from here. In fact, there's evidence that it's already improving a little bit, but I think it's going to be slow. This is the mortgage rate since 2023 when the Fed got done kind of tightening things up. And we've seen some general decline. Here was the increase just in the last couple of months since the Iraq war started. Not as big as a lot of people have made it out to be, but we were just about to dip below 6, didn't quite make it. We'll see whether we get back down there again. I think we will, but it might take some time. This has also affected the number of new listings that have come on the market. This goes back to 2000, and it might surprise you to remember that when you go back to 2004, 5, and 6, we were having, in 2006, we had almost 15,000 new listings come on the market in Dane County. Since the recovery, we've leveled off pretty much in the 9,000 range, give or take, again until the Fed tightened. Since then, we've seen a shortage of new listings here, and that's helped to cause the inventory squeeze that I'll address in just a second. If you look at this compared to, this is just laying in the red lines are the number of sales, the same thing you saw before, and then the blue lines are the number of new listings. And what's interesting about this, if you look at it, is that notice how back pre-housing bubble and crash in 2007, 8, 9, look at the gap between the number of new listings and the number of sales. And then notice during the period of quantitative easing, notice how that gap got shorter and shorter and shorter and shorter until by the time of the pandemic in 2020 and 2021, it was virtually gone. In other words, everything that was being listed on the whole was being sold. It created the short inventories and multiple offer situations that people are very familiar with now. Since the Fed tightened mortgage rates, we saw the number of listings go down and we saw the number of sales go down. And the gap has improved a little bit, but not as much as I think we would like to see. Now, I don't think it needs to go back to here, but there's been some improvement. And again, this is the period where we saw all that quantitative easing. So the question is, what's going to be happening now that that's done? In terms of new listings, we're not seeing a whole lot of help here either. New listings are up a little bit from last year, year to date, but not that much. This has led to what I would call a pretty severe inventory squeeze. This chart always gets people's attention. Back in 2007, we had 5,000 residential, single family and condo combined listings on the market at any one time. And you can see what happened during the recovery. And then down here into the 2010s. And then since the pandemic, we've seen this hugely low and we've recovered. This is, by the way, this is January inventories. This is the inventory that we began the year with. So that we have an apples to apples comparison year to year. But look how short our inventories are when you compare it to where we were a few years ago. This chart, this is what we published, that we update this chart every week. I updated it just this morning. Our agents, this is probably their favorite chart. It's a little busy, but I'll explain it briefly. This blue line here is inventories over the course of the year from 2019. And you'll notice that all the years that we have kind of follow this regular curve, rising, rising, rising up into about October and then falling. There's one exception, and that's this line right here. This is 2020, right here where my cursor is. That's where the pandemic began, and look what happened. Instead of rising like it was supposed to, inventories just dwindled and fell off the map, and we've been struggling to recover ever since. This red line is this year, 2026, and we started the year with a pretty good improvement over last year, leading us to think that we were going to see further improvement in the inventory picture. But as you can see, compared to last year, that improvement has completely disappeared. Right now, we're virtually tied with last year in terms of the amount of inventory we have on the market. This takes that same chart and just stretches it out over the course of the year, but it also breaks it out by condos down here, single family, and then the total. And there's something very interesting here that I want you to notice. You'll notice here, this is that little drop off in 2020. 2020 should have done this, but it didn't. It did this. And that's what sucked away the last of our inventory. But here's an interesting thing. If you look at the number of condos today, and this is the inventory as of this morning, 209 condos on the market. Compare that to about the time the pandemic was starting in 2020, pretty much the same. We've recovered. Look at where we are with single family, only 596 compared to 784 on the market at this time in 2020. In other words, we're still way behind in single family, not so much in condos. So condo inventory has pretty well recovered. Single family has not. In bar form, this is what that looks like. I apologize for the sirens out there. Hopefully you can't hear them. This is actually improved. This is condo inventory compared to last year. And we've had some improvement in condo inventory. But in single family, we are still behind even last year in terms of the amount of single family inventory that's on the market. This looked worse 2 weeks ago. It's improved ever so slightly. And the total of the two is virtually even. Chad's going to talk about new construction, so I won't spend a lot of time other than to show here. This we've only been keeping track of for a little over a year, but you notice that new construction inventory down here, this is properties that were built no further back than 2025, last year or this year. Single family and condo both. I've kind of created a baseline, but they haven't really improved. In fact, if anything, they're kind of dwindling off a little bit. So the increase in falling of our inventory is almost entirely due to resales, which makes me wonder how likely it is that we can build our way out of this. This brings me to, oops, we're missing one slide here, but that's all right. This brings me to prices. This slide is a little bit busy, but I can explain it to you pretty quickly. This blue line is the month-to-month median sale price, single family and condo combined. The red line is the 12-month trailing median, which kind of smooths out the seasonal variations. You'll notice that there's a seasonal variation every year. What's interesting here to me is that if you look at the 12-month median from the end of April of 2019 to the end of April of 2020, we saw a 7.14% increase in our median price. To 2021, we saw an 8.3% increase. 2022, we saw our biggest increase, even though interest rates had gone up, almost 11% increase in the median price. 2023, 8.3%, 2024, 7.7%. Then last year, we saw some decrease. It decreased down to about a 5% increase. And last year, in this year, from last year to this year, we've seen only a 3.4% increase so far this year in our median price. In other words, the price increases seem to be leveling off. And if this just shows the last 3 years, you can sort of the last 3 years, and you can sort of see how this goes. Here's the 420, which was 7.7% ahead of last year. Then you'll notice how in 2024, we were increasing pretty steadily month to month. And then toward the end, it all started to level off. We had a little increase through last year, and then it leveled off again through the holidays, which it had not been doing up till now. We've seen a little increase so far, but only about 3. This is updated through April. So we only see about a 3.4% increase from April of last year to April this year. Good news, I think, that we're seeing our prices level off, but with inventories as tight as they are, I don't think that we're going to see the price increases decrease. In fact, there's evidence that they may continue. Just a couple more slides here, and then I'll be done. This shows the average overbid month by month for different years. This year is 2022. It's the biggest year. In April of 2022, the average overbid on the property in Dane County was almost $17,000. This year, it's the lowest it's been since we've been keeping track, only $3,400. Earlier last year, we were actually under. This is where zero is. So we were under that, and I don't think we're going to be much above it. We're about less than 1% average overbid in Dane County right now on sales. So this trend, it was 4% back in 2022, has been decreasing steadily. And I'm hopeful that we're going to see that trend diminish and that we're going to see fewer overbids. But I have to tell you anecdotally that the agents are all telling me that the multiple offer scenarios are back with a vengeance. And we're starting to see a pickup. And I'll leave you with one final optimistic slide. These are accepted offers in April. And you'll notice that there's about a 9% increase from last year to this year. So this might give me some hope that we're starting to see more activity. Unfortunately, that means that our inventory is going to stay tight and it's going to put continued upward pressure on prices. So that's all I have. And I'll turn it back to Robert.
Thank you, Dave. That was very interesting. And I still think that it's the one slide that jumps out to me is that we live in a market where everybody overbids for almost every house that you always think when you list the price on a house, that's what you're hoping to get and it's going to come in under, but that's just not the case.
Yeah, it's gotten better. There you are probably seeing 60% overbids, 40% underbids, maybe even a little bit closer to 50-50. It's improved, but it hasn't gone away and it seems to be intensifying again. So we'll see.
All right. Well, thank you, Dave. And now I'm going to talk a little bit about the rental market. And the rental market, I think, is a very good story about that we're seeing a lot of the efforts by municipalities and by the housing community and everybody in that space pay off. So this is Greater Madison rental market. And on this slide, I just want to highlight that currently the vacancy range, depending on what you're looking at, is between 4 and 7.1% for renters. In 2022, it was approximately 1.9%. That's a pretty big, I think, jump and something that we should all step back at 50,000 feet with all the housing issues we have and recognize that a lot of what's going on is working. You know, the housing market doesn't turn on a single sweeping reform. It's kind of more like a ship, a small change to zoning here, a little more flexibility there, and over a consistent amount of time, you'll see the trajectory shift. And I can point out a lot of anecdotal stories, especially about the transit overlay district, where I've seen developers say, oh yeah, we went through with that project because we got a little bit more density in the TOD, and that was able to make it work. And it's all of those little changes that I think have done a lot for the market. And what we're also seeing is concessions. And when you hear about concessions, those are rent decreases. So people, I think, always have to keep in mind that when you value an asset like an apartment building, you're basically looking at the net operating income and you're going to be looking at the top end rental rates and projecting them out. So people who own those assets don't like to reduce rents because that projects out over time. So instead, they give concessions like a free month's rent. Well, one free month's rent is about an 8% decrease over the year in somebody's rent. So that's actually a rental decrease. So when you hear people talking about concessions, you're really seeing just another way to decrease rents in order to compete. So to me, what we start seeing is a little bit of a tilt towards the renter. And that's, though, in context, not in the sense that we have a very healthy rental market yet or that rental markets are affordable. It's just that we've seen progress. And to me, that's a very important point. Oops. All right. So this slide kind of speaks to that. I think one of the bigger point about the slide would be this second row right in the middle that talks about lower cost, mid-tier, and newer luxury. And this comes from the great City of Madison Housing Snapshot Report. Anybody that hasn't reviewed that yet should review it. It's just a great report the City of Madison put together. And what you would expect to see is a little bit unfortunate, but it's true, but it's a good sign. But the lower cost, the more affordable housing is still the tightest, but it's better than our average vacancy was in 2022 again. The mid-tier again, and then the newer, the most high-end expensive apartments have the highest vacancy rate. So this is the anecdotal side. For those who don't know me, I spend a lot of time in the housing market. I spend a lot of time with developers, realtors, and others and so this is kind of what we're hearing on the street, and that is that 1 free month of rent on a new lease, or we're seeing concessions are becoming standards. It's taking longer for new projects to rent up. And in order to rent them up and get them stabilized, which means 90% full or more, they're giving the 3 months rent. And some places are giving 2 months rent if you sign for 2 years, or 3 months rent for signing for 2 years. And you never used to see those. The lease ups have slowed dramatically. In the old days, 2005, 6, 7, and 8, even later, you would build an apartment building and it would be completely rented before you even opened the door, before there was a certificate of occupancy. People would sign a lease simply simply because they were afraid they weren't going to be able to get any better deal out there. Um, the point number three, even always full projects aren't filling. This is the first time I've ever heard of LIHTC deals, low income tax credit deals, and affordable housing, where you used to always see a long waiting list, have times where the project open and it's not opening at 100% filled. And when you see a demand resilient part of the market start to feel a little bit of softness, you can look at it as the broader market shift. And then kind of the most important is renters can shop, compare, and wait. A lot of people may remember when the City of Madison used to try to put in a time of the year, especially in student housing, that you could start showing properties, because people would be, you sign a lease in August of the year, and within 2 months, you're already starting to look for your following year's apartment. And so that was part of it, is that you could never see it. If you waited till June, July, or August, you'd be in this position that you may not find the type of apartment that you wanted. But now people can wait. They wait till, their lease is almost over and they can start comparing different projects and what are the concessions that they're going to get. And that's a huge benefit that has not existed ever since I became an attorney here in Madison back in the early 2000s. So we do expect, anecdotally, what everybody's telling me, that the market will tighten back up, the rental market, in 27 and 28. But I would always say every context matters to everything. All of the efforts that have been put in, if they had not put in, we would see probably an abysmal renters market right now. And we're actually seeing one that is tilting a little bit to the renter and causing rents to come down. So this is one slide I wanted to share that kind of goes to speak to everything you're going to hear today. It picks up where Dave left off, and then Chad will be able to pick up. This just goes through the end of 2024. It's from the Capital Area Regional Planning Commission But these are building permits on an annual basis from 97 to 2024. And you'll see that back in 2000 to 2004, maybe a little bit into 5 and 6, we used to build as much single family residential houses as we used to build multifamily units. The units are almost the same. For every apartment unit, there was a house. And you don't see that anymore. Now you see over time that where single family residential fell off and then straight line, multifamily has exploded. And that explosion of multifamily you see from 2020 to 2025 is what has caused the rental market to get better. But this tracks what they were showing in the residential single family owner occupied market. And then if you look at the two in the middle, there are 2 units and 3 and 4 units. And I would expand that to probably up to 10 or 12 units. That's just not how they did it. That's the missing middle. That's been missing forever. It was basically outlawed in the 70s, and it has continued to be there, and it has become the focus of so many of us in housing, is that we've got to get those numbers up, because those are the numbers that will refill that allow the
Robert, we've lost your audio. No. It's your Mike Gremlin showing up.
Maybe try taking the image, taking your video out.
Can you hear me now?
Yes.
All right. Uh, I was saying that the missing middle has been missing. And when the missing middle is missing, that's the gentle density, as Alder Tay Evers calls it. And that's what you'll see a lot of Housing Week and a lot of us concentrating on, really wanting to see that line go up, much like multifamily, the higher apartment buildings go up. I put in a quote from the mayor here that talks about the fact that, if we want economically diverse and vibrant neighborhoods, we need to build more homes, and we need homes of all kinds. There's a little shout out to the mayor's office, because I really believe the city of Madison and all of the municipalities in Dane County have really pushed and led on this to really try to bring housing to make it more affordable for everybody and diverse. And I feel, and I believe, and the stats I believe show that in the rental market, we're starting to see that happen, and hopefully we'll be able to start seeing it more in single family home ownership also. And with that, I will turn it over to Chad Lawler, who will speak to, hold on, I gotta stop sharing. Speak to new home construction and be able to take off from where we're seeing always the struggles.
Perfect. Thanks, Robert. Yeah. So Chad Law, I'm the executive director for the Madison Area Builders Association. We represent about 415 companies that work in residential home construction within the Madison area. About 103 of those are residential home construction companies and developers. So it gives us a unique perspective as kind of the group that represents the boots on the ground that are really constructing these single family housing that is needed. So I'm going to go through some current statistics, kind of give a full market update that we put together now on a monthly basis, and then talk about builder sentiment, which I think is an important component to understand as far as how they're currently feeling, how they're projecting for the future as well. So first thing to look at as we're talking about our current market is to kind of get an idea where we're at. Now, this information is going to be from end of month in March. So we haven't received our April data yet. That should be coming out in the next week. But year to date, we're a little behind where we were in 2025. Just a slight decrease. However, we did require the month of March to have kind of a rebound. Through January and February. It was significantly lagging behind on permits. And as you'll note here, just to kind of give you a reference point, in 2026, we had 286 permits for new construction starts, where it was 309 last year. But just in 2021, we were at 363. So you'll see there's a significant difference in that regard. And as you'll note at the very bottom there, I have it. 2025 was not a great year, so lagging behind 2025 is not kind of an area that we're currently looking to be at. So 2025 had the lowest permits that were pulled since 2015. And so lagging behind 2025 is not great. We are hearing that there's kind of been a push similar to what Dave had mentioned with current sale, because the market seems to be warming. We hope that the numbers will bear that out. Just as a kind of a point of emphasis, Madison in our market tends to have a significant amount of the new home growth within the state of Wisconsin. And while we are slightly down, the rest of the state is up. The Wisconsin Builders Association announced earlier last week that as a whole, the state of Wisconsin is up about 6% year over year. So obviously a positive in that regard to see that. But here in the Madison market, we are still lagging. And obviously, I think from a national perspective, we see the different reasons: material cost increase and availability. We continue to see interest rates be an issue. There was a definite correlation to the war in Iran that caused some slowing in the market. And then there was also some lag from the tariffs, and that impact has finally started to come into effect. That being said, similar to what Dave was saying about the increase year over year, has kind of slowed. In about 2022, 23, you're seeing about a $50,000 per year increase in the average cost of a new permit. We are seeing an increase still through 2026 and 2025. So currently we're at 568,000, was 554,000. That should say 26 and 25. Apologize. Square footage for those houses continues to come down over the last decade. About 10 years ago, that average house was about 2,800 square feet. In 2025, year to date through March, it was 2,455. Remarkably, it is the exact same amount through 2026. So still, you're seeing where that price is probably about $160,000 less for, or more, excuse me, for 400 square feet less over the last decade. So significantly less return on investment. As I mentioned, this year we're looking at 13,500 more for the same square footage on a home. Moving on, this is our new, move through this. This is our new market update. Green is good. Red is not great. So as we look at this market update, we're seeing all red. And it tends to go across the board, interest rates, etc. But one thing to note on here, without going into some of the vacancy rates, housing information that Robert and David already touched on, but looking at our lumber futures, currently it's gone up $20 approximately. Futures are looking into the mid 600s in July, August. So we are expecting and forecasting out additional increases in materials. We also see this with aluminum, steel, copper. Some of those products are up 25 to 50% in cost. So that material cost component is continuing to go up. One question I often get is, in 2020, the lumber, and it's done on 1,000 linear feet. It was about 400, but then peaked to about $1,200 per 1,000 linear feet. Currently, we're kind of climbing up towards that number again. Hopefully, we won't be in that realm. But that number has obviously come down from that 1,200 peak number. A lot of people are like, okay, so material costs has come down. Lumber prices have come down. It's a commodity product. It ebbs and it flows on future purchases. Other products do not. Other products, they're set pricing. A lot of manufacturers had updated their pricing, had done increases that um, hadn't been done previously, and we don't anticipate that those other products outside of lumber and other commodities will really come down at any point in the future. So unfortunately, we look at the different price points and cost factors of building a house, and you have items such as the material, the land, the labor. Land costs are significantly increasing. We hear from our developers that many quarter or smaller acre lots are going to be in the two to $300,000 just for the dirt. And so that's a significant burden and kind of creating a bottleneck as far as affordable and attainable housing from a new construction standpoint. And I just want to kind of touch on where the builder's confidence is. As you'll note on that last slide, I can kind of quick go back here. Builder's confidence coming soon. One thing that we can note on this is the National Association of Home Builders puts together a builder's confidence score. A good score is about 50. They've been doing this for several years now. Nationally, that number is low. We don't have a set number yet because we just started doing this in November, but I can still provide some of the information that we gleaned from it. So again, as I noted, 50 is kind of the baseline for confidence. Anything 50 and above, you would consider a good market. Anything below, you would anticipate as not being a great market. In March 2026, we were scored a 34 nationally. That was down 6 points from April of 2025. It is up slightly from midsummer of 2025, which hit a low of around 30. So it peaked back up, but has started to drop again. And I think, as I mentioned before, you have inflation, oil prices, the delayed tariff impacts, and interest rates really being some of those factors that are causing that number to come down. To give you perspective, during during the housing bubble burst in 2007 to 2010, that builder confidence number got down to about 10. So we are significantly above that as far as builder confidence, but we are seeing nationally significant reduction in the amount of homes being built. We're seeing a significant reduction in price points, but those tend to come from larger production builders who are publicly traded. Our market is highly custom builders, small builders, so we don't see those same kind of price fluctuations. So if you're looking, why is Madison's market not coming down where Phoenix or Charlotte, you're seeing a 15-20% reduction in prices? It's because those are builders who are doing production. They're publicly traded. They need to turn over capital and have to lower their prices to be able to offload that product to start building more. Again, we have a couple of those builders in our market, but they're very small compared to other markets. On a local level, just to give kind of an idea, we asked, our builder members, where are you feeling at the current market? And we gave them the option. It's poor, fair, good, great. And approximately 2/3 of those builders and developers indicated that the current market they would say is fair. Fair to good tends to be where most of our members responded. Very few, if any, actually responded that it was bad. So that provided us with a little bit of a positive outlook. However, as we asked, what do you see the future market being at? While fair has kind of come down, we did add several builders and developers who indicated that they expected, in the next 6 months that the market would actually slow and could be bad to worse. Traffic currently is approximately, average to below average. We are hoping, again, this is the spring selling season, that you're going to see that increase, where you're going to have the opportunity for the market to pick up. Hopefully next week when we have our numbers, we'll be able to see that permit starts has really increased. But while there is a lot of, cautious optimism that there's opportunities forward. I think we have a lot of burdens, a lot of barricades that are kind of stopping that from occurring. So with that, I'll stop sharing here and can take questions on some of those numbers later, but I want to give Olivia her opportunity to talk as well.
Thanks, Chad. That's those are really interesting numbers, and I'm not surprised about the impacts of some of our macroeconomic policy that's happening, especially the Iran war, interest rates, inflation. But it's interesting to hear about the lumber prices and how that impacts building here in Dane County. So I'm going to be talking about the regional housing strategy, give folks a quick a couple-minute intro on what that is, and then talk about some of the updates and some of the ongoing obstacles and opportunities. And let me share my screen for a second. Can you see that?
Not
Can someone
yet.
No, you can't see it?
Okay, but it's it's not the public view.
Okay. It's not the public view. Hold on a second.
I think you had it. You just had to put the slideshow on down below or up above. Start. There you go.
You can see it now?
Yep.
Okay, great. So, yeah, so we completed a 5-year strategic action plan and launched it in 2024. For those of you who are not familiar with the regional housing strategy, a roadmap to solving Dane County's housing crisis. And we created this, in response to municipalities, really urging us to look at this on a regional level. As you know, many municipalities around Dane County, as well as the partners here at this webinar, have been working on this issue for a long time. But obviously, housing is not just a individual municipal issue or a single industry issue. It's a really regional issue. And so we wanted to build on the efforts of the municipalities, organizations, and the private sector and work together to increase relationships, expand opportunities, prevent duplicative efforts, and leverage the resources and expertise that's out there, and develop a shared understanding of the housing crisis and the current trends. And so we put together a panel advisory committee of about 80 housing advisory committee members from 17 municipalities and 2 state representatives, as well as many private sector partners. And we met over the course of a year to conduct strategic planning around the housing crisis. And as part of that, the Housing Advisory Committee identified 6 core values in which to provide a basis and a framework for identifying their top priorities, strategies, and action items. And those are accountability, affordability, economic growth, empowerment, equity, and sustainable development. They used those to identify their top 5 housing priorities, increase the number of housing units attainable to low and moderate income households, increase the overall number of housing units, provide housing resources and protections for the most vulnerable populations, rehab and preserve affordability of existing housing, and provide more pathways to homeownership. It's really important for us to understand that the older housing stock that we have in Dane County, whether it's single family or multifamily, is very important to retain because, as you've just heard from my fellow webinar panelists, replacement costs of older housing stock is extremely expensive. And so it's really the largest source of our affordable housing stock in Dane County. The vision statement they came up with, which is RHS envisions an equitable and environmentally sustainable future where all residents have access to quality and affordable housing in connected neighborhoods. And as part of that, they identified production targets. So between 2020 and 2040, in order to address the housing needs and the affordability crisis, we need to create 139 new housing units, 64,700 new owner units, or 74,200 new renter units. And that represents 2,000 more housing units than we're currently our current 5-year average. So our current 5-year average is 5,000. We need to be building 7,000 units a year instead of 5,000. And 25%, 26% of all of our housing stock needs to be affordable to residents, or 60% AMI. That breaks down there's also a breakdown: 33 new owner units, 3,700 renter units, 1,765 affordable units, and 300 new affordable senior units. And this is the annual production housing goals based on the regional housing strategy for each municipalities in Dane County, cities and villages and towns. It's a aggregate number. So the strategic action plan takes those 5 priorities and identifies 17 strategies and 100 action items across each of the priorities. And this is just a snapshot. You can look at the regional housing strategy online, but it basically identifies the action steps and who the implementation partners are, the lead and the support partners. So virtually all stakeholders in Dane County who are interested or available and who are affected by this housing crisis are identified as implementation partners, and that's chambers of commerce, developers and builders, local municipalities, the private sector, nonprofit, residents, realtors, technical colleges, and workforce development. There's really a role for everyone to play. Since we launched in 2024, the regional housing strategies created a significant increase in momentum, awareness, and focus on the housing shortage and affordability crisis. There's a lot of new interest and attention from local leadership, and a lot of new partnerships between the public and private sector, the nonprofit sector, and the private sector, as well as the public sector. We have 3 new housing planners in Dane County. The city of Sun Prairie has a new housing planner. Middleton and Fitchburg also have new housing planners. And then there's been, a significant change in local investment. So the new state legislation allows for a 2-year TIF extension. So when your TIF tax increment district closes, you can actually hold that district open for 2 years and take that increment. And this is an example. So if your TIF closes in 2024, you can use the taxes for 2024 and 2025 and put that into a housing fund. And that could be several hundred thousand, it could be up to 10 million. And there are now 9 communities that have housing funds in Dane County. 75% of that increment needs to be for affordable and workforce housing, and communities are using that money for rehab, major and minor home repair, down payment assistance, energy efficiency upgrades, housing counseling, land banking, and gap financing for affordable housing. And the Dane County and City of Madison increased their affordable housing gap financing from 15 to 20 million. So that's another 10 million annually. So the city and county just alone have 40 million for new multifamily affordable housing gap financing. Dane County also created something called the non-LIHTC housing program for rehab and preservation and acquisition rehab of older multifamily housing stock, naturally occurring affordable housing, which is what I was referring to before. We distributed 8 million last year, and we have another 4 million last year. We had another 4 million this year. This is really good news. The city of Madison pledged to make 25% of all their new housing affordable to low to moderate income households. That is critically important, not only to the health of our communities, but certainly the employers and the school districts who employ our low to moderate income workers. It's critical for them to have housing so that they can do all the things that we count on them to do, whether it's taking care of our elderly parents, teaching our kids, and all of the jobs that tend to be lower and moderate income and hourly. The county also received $8 million, a HUD Pro housing grant to help communities update their residential zoning codes and permitting processes and planning projects associated with removing obstacles to housing production. Some money is going to go to land banking and also to emerging developers of that $8 million. And then the regional housing strategy has really generated a significant interest from the private sector. I've been kind of inundated in a way from the private sector asking about this. And over the last few months, we have been in discussions, myself and the nonprofit housing developer community, and is sort of a pathway now for developing a new regional housing fund to streamline private sector partnership and investment in affordable housing. Look to the fall to hear more about that new fund. And last year we developed the new best practices residential zoning code guide to address the housing crisis, the housing shortage and affordability crisis, which I think has been extremely helpful. A lot of communities are using that as they update their zoning codes and as a communication tool. Last year, Dane County partnered with the Realtors Association of South Central Wisconsin and had a 4-month metro advertising bus campaign around the housing strategy. And basically the tagline is, "We need more housing." We've developed some fact sheets, which are really helpful communication tools for local municipalities to understand, what the housing crisis is, what zoning has to do with it, what affordable housing is, what missing middle housing is, and racial discrimination in homeownership was a very important priority for the Housing Advisory Committee. So every year we're doing webinars and providing information. We also have evaluation for these villages. We took all the action items out of the housing strategy and put them into evaluation checklists, so municipalities can get a better sense of if they're doing some of these steps. And basically, it's a conversation starter and a checklist that they can use to see what they're doing and what could potentially be doing to address the housing crisis. Some of the pictures from our bus campaign, and then we have a new website, and we're providing technical assistance. We also have an annual meeting every year, and we have one coming up. This was the one from last year, and we're producing educational webinars on planning and zoning and financing, TIF programming, sustainability, have monthly newsletters and an annual progress report. Last year kicked off the Hometown Hero Awards, and we're going to be doing that again next year. This year on June 30th. So anyway, obstacles to housing in cities and villages. There's an ongoing lack of understanding and awareness about housing shortage, how it impacts people, families, employers, districts, public safety, and local economy. This is probably one of the single biggest thing I hear from communities about one of their obstacles and challenges to bringing more supply. What are we up against? What's at stake? What's it going to take? What is it going to cost? And what's the cost benefit of the status quo? So that there's just an overall lack of general understanding and resistance to change and fear of change, which is understandable. When you've lived in a single family community your whole life, and then all of a sudden a multifamily building goes up, it's a little intimidating. It's you're not familiar. It's people are unsure about that. So obviously we have outdated land use policies and zoning codes that very much need to be updated. Public hearings are typically not representative and get rejected often. I hear that not infrequently in Dane County. When we have a housing shortage, there was a multifamily development a few weeks ago that got turned down in Mount Horeb. So this happens. And so looking at public hearings and how we can better include people, I think is something that we should be considering going forward. And the lack of private sector investment and access to capital. And construction labor shortage. Chad didn't talk about that, but that has been an ongoing problem for at least a decade. And there is some opportunity for us to work on that going forward. So we plan on doing a comprehensive outreach and education campaign over multiple years, starting in 2027, to inform, engage, and share resources and solutions, and really help engage the local leadership and the general public about the housing crisis and how it impacts them. Updating land use policies and permitting and zoning codes that reflect the new normal and meets the needs of residents and employers is absolutely critical. You've heard from a number of panelists today that housing prices have gone up, 50% since the pandemic. And if you have to ask yourself, how many people's salary has gone up 50% since the pandemic? So we're really having to think about a new normal and what that looks like in terms of permitting, zoning codes, and housing stock going forward. We need new strategies for public hearings that are more inclusive and representative. And then we need increased capital, access to capital for our nonprofit housing providers. The Housing Advisory Committee very much wants to keep the ladder into homeownership alive, and it's all but broken in Dane County. And so we really need to figure out a way to invest in our nonprofit housing providers who can bring forward that entry-level home that is no longer really economically feasible for your conventional builder, market rate builder. So increased partnership and investment, as I said before, and a new vision for housing for the 21st acknowledges the challenges we face and incentivizes innovations. We're going to be talking about it coming in June 30th. And leadership from all sectors. It's really critical that we have leadership from all sectors. If it's a neighborhood organization or a church group or small business, everybody really needs to be involved in the solutions and a sustained commitment and partnership over time. So, yeah, it's important that we take the next step together. And on that note, I want to invite you to come to the June 30th Alliant Energy Center annual meeting. We have two panels. Elected officials are going to be talking about making the hard decisions and what the obstacles and opportunities and their vision for the future is for our new normal in housing. And then we're also going to be talking about specifically the fact that the housing ladder into housing and homeownership is broken and what we can do to fix it. And we have a whole panel of affordable housing developers, single family affordable housing developers, mostly nonprofits, but two for-profit builders that it would be wonderful for you to meet if you're interested in this subject. I think at this point, that's all I have. Please visit our website, sign up for the newsletter, and please join us on June 30th at the Alliant Energy Center.
Great. Thank you, Olivia. I did share the website in the meeting chat, so people will have that there. We do have two questions, and so I will read them off, and then hopefully we can get them answered here. So the first is for whoever wants to take it. With the rental market becoming more healthy and purchase market being super tight, does this lead to potential condo conversion projects? And if so, what does this take versus new build condos?
You want to try that one, Chad?
That's what I was going to say.
I appreciate that, guys. Yeah, I mean, it's possible. I know there's been a lot of talk from developer members of ours and others who have had interest in creating even commercial spaces into condominiums. There's certainly challenges, and I think, we often get the question, why are there not more condos? It previously was a problem with zoning, and a lot of municipalities didn't allow it. But really, for new construction of condominiums, it's a financing component that still really hampers any condominium process. Having to sell, previously it was 60% had to be pre-sold before construction for financing. It's been lowered to 50% in some instances. So there's been some easing, but still it's a lot easier to create a multifamily rental opportunity than it is for condominium from a financing perspective. I wouldn't say no, because I mean, since I started with the Builders Association in 16, condominiums have grown, and the ability to do them has been made easier, but there's still a lot of financing restrictions.
I would just add that all of those financing restrictions for new construction is the same for condo conversions if you're talking large buildings. But the hope is to see more condo conversions in the missing middle, where some of those financing constraints and liability issues I don't believe apply as strongly as they do to converting like a large office building or a large apartment building.
Yeah, I would only add just briefly that the financing issues are what I hear all the time. Back in 2004, 2005, you saw a lot of conversions of apartments into condos, and it was a great way to go. But the concentration of risks issues that the Dodd-Frank law and a lot of others put into place back after the last recession, condos have just been very, very difficult to finance in any form. I just remind you, we are seeing some accumulation of condo inventory, better than single family at the moment. It's still not ample. Now we're starting to see issues with some of the associations, which I think are also impeding some of the sales and causing some buildup of inventory. So I'm hopeful that will continue, but it just condo building and conversion just continues to be a real issue, particularly for the financing reasons.
Great, thanks. And Chad, this one was generated like right after your market report, so this might be another one for you to start off with. So Jay writes, how is our market new construction affected by aggregate material costs and interest rates, yet the state is increasing new construction?
I just how is the aggregate cost and material costs, but the state compared to the state
Uh,
seeing
Jay,
growth?
if you're on and want to come off mute and maybe I just didn't read it right, to ask your question.
I think he means aggregate costs, not aggregate as in sand and
Ah,
gravel.
yeah. I'll note too, and Jay can chime in if I'm not answering correctly. I think, you mentioned the state increasing and that percentage going up. That's a much smaller number, and a lot of it is some counties are 140 to 200% up, but we're talking permits where, an average year they do 12 to 30, and in this current year they're doing, instead of the six they would normally have at this point, they're doing 8 to 12. So the numbers in totality are significantly lower, but they're making up for the fact that Dane County, which is usually the kind of the leading edge of the spear, is down. Now, granted, we're just barely down, so other parts of the state is just pulling us up.
I think, Chad, I would add, and you can please correct me if I'm wrong, but one of the issues you see in Dane County is a lack of developed lots that builders can build on, and then a lack of labor for other builders to come into this area. So we have more than enough demand to increase our supply. We don't have enough land and enough developed lots and enough labor. And that's where I know of one national that has moved out of Wisconsin because of the lack of labor. And they just couldn't build the number of units they wanted to build.
Yeah, that's correct. I mean, we have a lot of municipalities that reach out pretty frequently and talk about they only have a year and a half to 3.5 years left of land that's developable. But even in those circumstances, often it's land that's the landowners aren't selling. And just to give kind of an idea on an overall permit basis, in 2003, 2004, we did about 2,600 new home construction, single family. We're currently averaging about 1,300 to 1,400, and the demand has been there since then. We just don't have the capacity to build nationally. The number of individuals in the construction industry practically were halved in around 2010, and really have had a hard time catching back up. State of Wisconsin added 10,000 individuals into the construction industry over the last 12 months, and it still pales in comparison to what's required to reach the numbers. And to Robert's point, yeah, national builders are bringing subs up from Northern Illinois just to fill, expecting to do hundreds of homes per year, and they're doing teens. And that's not something that a builder who's used to building 75,000 to 90,000 homes is used to seeing, because they usually work off of, you know, economies of scale.
So now, before you all log off, I want to put a big shout out for tomorrow's Madison Housing Week presentations because they're going to fit right in. At noon tomorrow, there's a webinar on when Durham, North Carolina, legalized homes on 2,000 square foot lots and less than one-third the traditional minimum, with homes capped at 1,200 square feet. And builders responded immediately, delivering smaller, more attainable homes at scale. Aaron Lubick from Incremental Development Alliance will break down how it works, share real examples, and explore how Madison could do the same. This is absolutely going to be a great webinar. We have a ton of people signed up. If you're a housing geek, I think it's a must see. And then tomorrow evening at the Tinsmith, we have everyday perspectives on Madison, free food, free drinks, and a great opportunity to meet and talk with others in the housing community. You can find out more about them at madisonhousingweek.com. That's madisonhousingweek.com. Thank you to everybody on the panel for coming out. Chad, Olivia, David, and Darren for helping host. We all appreciate it.
Thank you, Robert.
Sure.
Thank you, Darren. Great to
Thank
see
you.
everyone.
Yes, thank you. And just for those who are joining, you'll get a follow-up email tomorrow morning, and there'll be a link for the recording of this webinar. So thank you all.